Things are going well down here. Life's all right. You know, the weather's changing, the fall's happening. The fall in the stock market hasn't hit yet. Maybe it's not
Yeah.
coming, but
Yeah.
the yeah.
Well, let's get into that. The fall in the stock market is something that you know does get talked about, and we're seeing some conversations about it here and there in the news, and wondering when it is going to happen or when it is going to fall, right? So September, another crazy month for markets, I think. It's fair to say. We had a rate cut by the Fed, missing a job report. We've got the government shutdown, of course. So, Marcus, what's on your mind for the September summary?
Yeah, so as far as September goes, just jumping off with the fall, there's a concept called the September effect. I don't know if it's more mindset or more actual effects. It's where the stock market generally declines in September. It'll start strong, go down towards the second part of September, and then October has generally been the weakest month in history for stock markets. But you have to think about some of the events that happened in October with the stock markets. Black Monday, 1987. These were October, so they skew the market when you look at those histories. But in general, the stock market is just churning on, churning on. One reason is the unfortunate government shutdown that we're going through right now. The stock market in general in history, when you have a government shutdown, as long as it's not a long duration stock shutdown, the stock market tends to do better. So even with the Fed's rate cuts, another boost to an economy that people think could use the rate cuts as far as housing market goes. You have we don't have the data coming in as we talked about with the government shutdown. So we're lacking some of the data. People are turning to other sources for data. So they're turning to the private markets like the ADP. The Chicago Fed office has a tracking tool that mixes individual data with private data. I think they use some of the state data and they come out with figures. So their figure would have been, it's not official, but around 4.3% unemployment. So that's generally around where we've been trending. The inflation number that we didn't get, uh, or that we may not get due to the government shutdown, that'll be a little more tricky to track from the private market. But we feel inflation as consumers every day.
Hmm. Yeah. Would you say that that the inflation we're feeling is the same as, say, a couple months ago, where it was maybe more cost push oriented to specific types of products, depending upon what was being specifically hit by tariffs versus maybe longer term effects, or the overall economy? Because I know that a lot of economists have agreements and disagreements about what to call inflation, or when to say we're in an inflationary period versus a few products or a few services being affected versus in converse to the whole economy, for instance. So what's the general consensus, if there is one, on are we in an official overall economic inflationary period?
I think so. Inflationary pressures are definitely higher right now. Inflation has been felt differently this time because inflation, I think, is hitting different sectors. It's not hitting everything at once. I
Mm-hmm.
mean, generally prices are going up slowly but surely, but like certain sectors are feeling it more. And it was rolling maybe with the impacts of tariffs, as certain sectors and tariffs impact was hit harder as it rolled in to be figured out by the corporations. As I mentioned before, corporations they'll figure it out. They're going to pass these tariffs off either partially to themselves, partially to the country they're receiving them from, and then partially to the consumer. So it's just a matter of the mix. Uh, to begin, the companies and the producers seem to be absorbing most of the tariffs. So the inflation has seemed to be rising slower or staying consistent. But eventually, that'll have to be passed on more to the consumers. As shareholders and stockholders want to see more margins in their stock prices. That's just the way of the world with investing in corporations.
So you're saying that there's been some pass on to consumers, but we're not seeing quite the hit that we might possibly in the future.
Correct. We could see a higher hit with tariffs, and that's also one of the things that the Fed is talking about as far as like the balancing out. They're not sure if this is a one-time price shock from the tariffs or if this will be continued pressure from the tariffs. Without having data coming in right now, you also have cloudy and foggy views as to whether this economy is growing because the economy is growing really fast. You don't want to cut interest rates in a growing economy. That's going to create more inflation, right?
Yeah.
You don't want it to grow rampantly uncontrolled. So all that being said, uh, the inflation in the housing market, if you look there, so we're talking about sector wise, look at the housing market. And I know I feel good about the housing market coming into the second half, but just uh, earlier today, I saw like the 15-year is under 6%. The 30-year is getting closer to 6%. I think at the beginning of the year, the 30-year was 7.4, 7.14, and
Yeah.
right now it's pretty much 1% below that. So housing markets and mortgage rates take a long time for those type of inflations to come down, but directionally, inflation is coming down. So it's in different sectors where it's rising and where it's falling.
Yeah, and I want to come back to that concept about things, certain things taking longer than others to catch up and how they can influence one another, policy versus the financial sector, that kind of thing. I want to come back to that in a bit. So you mentioned unemployment, and I believe you had said earlier in the segment that it's kind of been holding steady, but it was what was the percent again? 4 point something?
According to the Fed's, Chicago Fed's system that they run, it's not the official one because they don't get the official data. I mean, like I said, it's a compilation of the ADP, like private data information and some state information, but it's at like 4.3.
Okay, okay. And I know on I think it was Moody's, couple places, Squawk Box, just the general places that a lot of people see financial news, like myself, just quick in the morning. But the feeling is that companies, and you mentioned this too, they're kind of waiting to see what happens a lot, so that they're absorbing the tariffs for now in some cases, but they're also not hiring as far as we can tell. So we're seeing that. What is the change, if you remember the change rate, from let's say the beginning of this year roughly to now in the unemployment number?
The number has been wanky, or that's not really a good word to say, but it's been out of sorts, so you just got to look more at the percentage. It's been right around 4.2, 4.5%, in that range, 4 to 4.5 the whole year, pretty much. The thing that you need to look for with the unemployment, as these numbers say the same, is the duration of unemployment. So like the JOLTS number, jobs over lost turnovers, you need to see how long people are staying unemployed because okay, so we have inflation. If we have inflation, even if inflation continues to grow, if you have wage growth and growing GDP, they can kind of combat each other, right? But when people start losing their jobs and then people start losing their jobs for long durations, that's when the economy could falter or buckle. Like that, not having jobs and not having money to spend is when the economy really, really would start to feel the pressure. Inflation is bad. Right now, we're more towards I hate to say it, maybe stagflationary situation where we're just kind of stuck with this inflation, stuck where we are with the jobs market. But if this duration continues to extend in unemployment, or people who aren't even going back to work, or the underemployed, people who are, doing jobs that they're not technically trained for or qualified for, those type of things start to show cracks in the economy.
Yeah. Yeah. It's all kind of interesting, I think, how this is all going to play out, and certainly, you feel like sometimes that news reporting on it, there's always this it's fast paced, and it's the same thing with the change and turnover with policy making and all, the politicians or people, getting elected office and then new people coming in. And so I wanted to kind of return to sort of the pace of things and your comment about how long it can take for certain things in the market to take shape versus others, and how those are influenced by other factors that are moving faster than, say, the financial world. I got a question for you, and it was just something that was on my mind last night because I was reading an article in the Time magazine. And folks, if you're interested in taking a look at it, it was by the author Justin Warland, Shifting Winds. So this article was about clean energy and the clean energy transition. And I got to thinking about that we were going to do this, have this conversation today, Marcus, about the overall market. And of course, clean energy, a lot of companies, big companies, as well as banks, large banks, have been investing in clean energy for some time now. And of course, they were hoping to take advantage of some of the opportunities that would have been in the previous bills from the Biden administration, the infrastructure bill, and so forth. Some of which are there, some are going to phase out, others are going to be completely eliminated, unfortunately, where clean energy is concerned in particular. And so, reading this article, it seems, according to the article, that large banks like J.P. Morgan, they met recently with some other bigwigs in Scottsdale, Arizona, and they're discussing the dilemma that they're in. And if you just listen to the political reporting, you would think that clean energy transition is dead, that it just died. It's dead on arrival with the incoming of the Trump administration and Republican control of all three branches. But I've often thought that, and this article alludes to it as well, that the mistake we make about not only how we talk about clean energy transition, but also how we invest in it and how the market behaves, that it's never a zero sum on either side. It's never all one, it's not all fossil, it's not all clean energy. Everything just transitions and changes at the exact moment that you want it to, regardless of what side of a person is on with that politically, which of course we don't deal with that here on this podcast. But in terms of financial markets, one of the things that stuck out to me in the article was that companies like J.P. Morgan, who are investing both in fossils but also have been made significant investments in clean energy, they get criticized from both political sides of the aisle for that. But they've really got a dilemma of they are invested in clean energy and have been for some time. And so even if politics changes rapidly, there's no guarantee that the financial sector can make those kind of whiplash changes, nor might it be in their best interest. I'm just curious what you think about all that. What do you see as evidence maybe in the markets of these prior commitments to clean energy goals, even if it's not an emissions specific goal, but just that they're going to continue working on transitioning gradually from fossils to cleaner energy? What do you see happening in terms of what they may do in the markets, or is that another wait and see kind of scenario?
Yeah, so I think you actually pointed out a lot of good points in there. Actually, how everyone's balanced on both sides when it comes to investing in clean energy versus fossil fuel.
Mm-hmm.
Go back to the 70s when people couldn't get gas, to the 80s where we started, we were going to make sure we had gas with Reagan, Bush, we had gas. Then Al Gore was running for president. He was one of the first people who really pushed climate change, those type of things. So that administration, well, Clinton was president, Gore was Clinton's vice president, but that was one of his initiatives when he did run for president. So that started a conversation, back, and then Bush, Iraq, all these things. So it's been a constant shift, Obama, Trump, Biden. So let's just go from the Biden to current, right? Because that was a big shift with the EV credits. We had legislation pushing towards more EV credits for people to purchase EVs, for dealers to sell EVs.
Even he kept some of the initiatives that the first Trump administration had, because we ended up with the war in Ukraine. So we're always fighting this current energy demand, which right now, is still fueled a lot with fossils, and even clean energy relies on electric batteries rely on the sourcing and extracting of fossils. So I'm always fascinated by the how the conversation maybe doesn't sometimes meet reality, and how the markets get maybe caught in the middle. Would you say they get caught in the middle?
The markets are caught in the middle, but the markets move fast. These banks are moving slower. They're going to allocate their funds for, I guess this last administration, it was clean energy. They just moved some of those funds more towards the fossil fuels, because even when you're using like nuclear energy, you need like coal and fossil fuels to run the facilities that's going to create that, until they figure out a way with the natural gas how to do those things. So yeah, banks are investing in those type of things on both sides, playing both sides field, because they know the political environment is going to change. It always changes. Mm-hmm. This stuff isn't in law. It's set up where it can be changed every 4 years, depending on the administration, right? Depending on the legislation coming out of the office, the temperament of the country. So these companies make huge investments, and they make long-term investments. So they can't shift on a dime just to say, all right, we're done with this facility, we're done with that facility. Because the people who are building these actual facilities, So JP Morgans of the world are lending money to these companies to build these construction companies who have to hire workers and build materials. But if you just take all of that funding away, you can't just outfit a building that's been built for one type of energy into another type of energy. Just like it's not as easy as people think it is. It's just not that easy to retool a facility. So yeah, the money's in there, the money's moving. I think it's just more of a shift to where the money's actually going and what the actual like bankers and investors are talking about. Because Chevron, ExxonMobil, I heard those CEOs speaking just about how, yeah, they thought maybe some of this fossil fuels were obviously good for them. Everything like some of this clean energy stuff, they didn't really know, but they just kind of went along with the administration because it's just easier not to fight the administration when they know they're going to be there longer.
Yeah, yeah, and I think we're in a um, an era where there's a little bit more spotlight on banks and companies, just by the nature of communications, between the government and those companies. That's a little bit more public facing maybe than we're used to seeing sometimes in the past. So that can put pressure on what their decisions are too. But it was an interesting article, and I just was curious what your thoughts were on it because overall the article was alluded, talking about how the banks in particular, but even large companies who are receiving those funds and investments, trying to work through a dilemma of they're really the despite what's happening politically and even in policy. I think we have seen enough public interest, enough change over the last 20, 30 years, especially towards a climate conscious society in a way that isn't easily reversed by one or two policies and as you pointed out every 4 years there's another change that's possibly coming, so it will be no pun intended, interesting to see how companies, banks, and the market in general weather that storm in that topic. So we'll wrap it up, but just wanted to give you a moment to offer any other final thoughts, especially what are any implications or thoughts you have that are helpful to Main Street relative to how you try to help them meet Wall Street.
Perfect, right? Yeah. So helping Main Street meet Wall Street. I don't think I even gave you an example from the last question. So let me give you a quick one with that. As
Yeah.
far as like the climate change and the shift in policy, just take Tesla, for example. Their stock price has been surging. The EV credits are expiring at the end of the year, or before the end of the year, maybe. So people are pushing to buy the EVs if they want to have them now with those tax credits, which were reduced earlier this year. Anyway, but as far as what I want Main Street to know, Main Street to meet Wall Street, just information is key. There's a lot of information out there. Be careful with the information you take in. I don't want to say fact check because I know it's like a bad word now, but like double check what you're looking in. If you're going to invest in something, please invest in something that you understand. Don't go out here and invest in something that you just hear or think about or just see on a social media stream. And the market trees don't grow to the sky. So if you see a market correction or a market dip, don't panic. Don't go sell everything. Because if you're investing in stocks or bonds or anything like that, it's only a loss if you sell. Otherwise, it's just a paper loss. If you can weather the storm, history shows that it'll come back up. But we're in the middle of a bull market right now that could run for years or it could run for a month. We'll just see how it goes, depending on the political environment and depending on if AI is just, if AI came out and was just, obviously, I don't think it is a flash in the pan, you would see the market go crazy.
Well,
Like,
this is what the ABC squared helps people do. This is what you do, right? You help people weather these storms and understand better what their choices are. So, folks, check it out, the ABC squared. And I think you can definitely find Marcus on LinkedIn. And what's your website address again? Is it abcsquared.com?
right, that's my website and have a YouTube channel I just started. So some videos on there, offer some financial literacy and
Fantastic. Great.
stuff with you and I on there, Christy. So
Yeah, absolutely. Yeah. And we do this every month, folks. Thanks for joining us. Thanks for listening in or watching, depending upon where you get your podcasts and how. This is Policy for Normal People with Christy Amada and Marcus Sturdivant Sr. of the ABC Squared for our monthly September market update. We'll see you again at the end of October for this same type of segment. Thanks a lot, Marcus. Enjoy the month.
thanks, Christy. I'll see
See
you next.
y'all. Bye bye now.
Bye bye.